Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about what's happening in the Chinese economy. Now, if you've been following the channel, you'll know that I recently posted a video looking at the level of imports and exports in February. And the reason why that's so important to China is because trade makes up more than 37% of total GDP. China is a manufacturing country. It sells things to every country in the world, and so it's dependent on those overseas sales. And right now, the Chinese economy is struggling because Donald Trump has imposed additional tariffs of 20% on all exports to the USA. And the USA is the biggest single market, accounting for around 15% of the total value of China's exports. So China's already struggling in terms of what's happening externally. But in today's video, I want to talk about what's going on internally, what's happening with consumer spending and inflation, because there are serious problems happening in China as well. This chart shows the annual growth target set by the Chinese authorities for the Chinese economy dating back to 2008. And you can see that back in 2008, the target level of growth was set at 8%. However, actual growth came in at more than 9.5%. And you can see that between 2008 and 2011, the Chinese economy continued growing very rapidly. The target for growth was dropped to 7.5% between 2012 and 2014, and the Chinese economy came in at or around that level. It then dropped to 7% in 2015, 6.5% between 2016 and 2018. It fell to 6% in 2019 and was maintained at that level in 2021. There was no target set in 2020 as a result of the COVID-19 pandemic. The target came down to 5.5% in 2022, and since 2023, the target rate of growth has been set at 5%, and that's what the authorities are looking to achieve in 2025. And if you take a step back and have a look at the overall picture here, you can see that over the past 16 years, there has been a slowdown in the growth of the Chinese economy. And what we're seeing in 2025 is a continuation of that slowdown, and there are some serious concerns as to whether or not the economy will be able to achieve 5% growth, because it only just squeaked in at 5% for 2024. Well, the figure here is an estimate. We haven't got the final details yet, but everybody's expecting the Chinese authorities to announce that it did achieve growth of 5% for the full year of 2024. As I said at the start of today's video, the Chinese economy is dependent upon its export trade. It produces around 37% of China's total GDP, and that is significantly higher than the other big economies in the world. And the flip side of that equation is that the GDP that's being produced by household consumption in China, internal demand, is significantly lower than it is for other big economies. This chart shows the percentage of GDP derived from household spending for the four largest economies in the world, and also shows the global average. The blue line at the top of this chart shows the percentage of GDP derived from internal spending in the USA. What this line shows is that over the past 60 years, the percentage of GDP derived from household spending has increased in the USA, and it's currently sitting at around 68%. The black line shows the global average, which is currently sitting at 55%, and that's exactly where the Japanese economy is sitting right now, shown by the light blue line. The green line shows the figures for Germany, which is currently sitting at 50%, and interestingly, over the past 60 years, the percentage derived from internal expenditure has fallen. And the red line at the bottom of this chart shows the percentage derived in China, and you can see that the current percentage is 37%. Which is 30% lower than it is in the USA. And as you can see, over the last 60 years, the percentage of GDP derived from internal demand has been falling. And the reason for that is because China has become a bigger player on the global market. It's exporting lots of products. So as its GDP has started to expand rapidly, most of that is coming from its export growth. But the problem that China has is that you then become dependent on the global markets, which are more difficult to control, particularly when you've got a situation as is happening right now, where Donald Trump is applying tariffs on Chinese exports. There is nothing that China can do about that other than to apply tariffs on imports from the USA, which it has done. But the problem with that is it's going to increase costs and make things more expensive for Chinese consumers and businesses. Now, one of the things that the Chinese authorities have been doing to try to boost demand and increase spending is to provide subsidies and trade-in deals to encourage Chinese consumers to spend more. And it was recently announced that this stimulus package will be increased from the previous level of 150 billion Chinese yuan in 2024 to the new level of 300 billion for 2025. And the way that these deals work is that the Chinese authorities are basically paying Chinese companies to offer discounts to Chinese consumers to buy more of their products. So those discounts may come in the form of just a lower price or a trade-in deal. You can bring your old appliance or car or bike or whatever it might be and get some sort of discount on the new product. And the range of things that you can actually trade things in against is really quite significant. This table shows a selection of the products where you're able to trade in your old good to get a discount on the new purchase. And as you can see, this list includes items such as refrigerators, washing machines, televisions, dishwashers, microwave ovens, household stoves, cell phones, tablets, smartwatches, fitness bracelets, as well as electric vehicles and electric bicycles. So basically at the moment in China, you can get a discount on virtually anything that you want to buy as long as you bring your old one along to the store. And this is quite interesting because over the last 6 months, some significant tariffs have been applied, particularly against electric vehicle imports coming out of China. And the reason why the other countries have done that is that they were accusing China of subsidizing all of the electric vehicle manufacturers, enabling them to sell their products at significantly cheaper prices than other manufacturers can produce for. And of course, that makes it unfair in terms of the competitive landscape. Now, China has denied that. They've said that they weren't subsidizing any of the Chinese electric vehicle manufacturers. They were just able to produce them significantly cheaper. But when you look at what's happening in the internal market, China is actually subsidizing virtually everything that's being produced in China. It's giving money to all of those companies to be able to sell their products cheaper, so encourage people to buy more. So you have to believe that it's likely that the electric vehicle manufacturers were also receiving some form of subsidy to reduce their overseas prices. So there does seem to be some validity in the additional tariffs that have been applied against Chinese electric vehicles. And I think this is one of the reasons why Donald Trump has imposed the additional 20% tariff on all Chinese imports to try to make it more of a competitive landscape and allow American companies to be able to compete on price. This chart shows the year-on-year movement in the official rate of inflation in China, and the scale on the right-hand side of this chart goes from 1% positive at the top to 1% negative at the bottom. So we are looking at very low levels of inflation here. When you think about inflation in the rest of the world, we've been talking about rates of 4, 5, 6, maybe 10% over the last couple of years being problematic. What we've got in China is virtually no inflation. Now, if we look at what's been happening over the past 12 months, in February 24, inflation was running at 0.7%. And actually, that was the highest level that China has seen at any time in the last year. And if we look at the most recent data for February 25, you can see that year-on-year prices fell by 0.7%. The chart has dropped below the zero level. And what this represents is deflation. Prices are now falling in China. And if we expand the scale of this chart to show what's been happening over the past 3 years, you can see that this isn't the first time that China has fallen into a deflationary cycle. It actually happened at the end of 2023. In October 23, prices fell by 0.2%. They then fell by 0.5% in November, 0.3% in December, and hit a low of 0.8% in January 24. So the current set of results represent the first time in the last 12 months that China has fallen into deflation, but it's been struggling to achieve any significant inflation for a long period of time. As you can see on the right-hand side of this chart, the scale only goes up to 2.9%. And this does actually represent a serious problem for the Chinese economy because it's dependent on manufacturing. most of the GDP for China comes from its companies producing things. And if prices are not increasing, it means that those companies won't be able to increase their prices on the shelves, and therefore they can't pass on any of their cost increases. So all the raw materials that they're buying from overseas, and any pay increases, and any increases in terms of electricity costs and rental costs, and all of the things that a company has to pay out, if you can't pass on those cost increases, then you have to absorb them, and that means that your profits will be falling, and potentially you could fall into a loss-making situation. This chart shows the year-on-year movement in producer prices in China, and producer prices, as we've discussed before, are also referred to as the factory gate prices. So this is the price of a product when it's leaving Chinese companies. And the scale on the right-hand side of this chart goes from 0% at the top to -3% at the bottom. And what this shows is that over the past 12 months, Chinese businesses have seen year-on-year falls in their factory gate prices. And the most recent figures for February 24 show that year-on-year prices fell by 2.2%. And if we expand the scale of this chart to show what's been going on over the past 3 years, you can see that producer prices have actually been in negative territory in every single month since October 2022. And this is an absolute disaster for Chinese companies, because what it means is that they're unable to pass on those cost increases that we just talked about. And so month on month, things have been getting significantly worse for the Chinese businesses. They will be posting lower profits or losses. And it's estimated that around 50% of all Chinese manufacturing businesses are currently making losses. And that situation is set to get much worse now that the 20% additional tariffs are in place in the USA, because the biggest single market that these companies are exporting to has now seen an increase in their prices, and that means that it's likely that they'll see a fall in sales, a fall in revenue, a fall in profitability, and the situation is getting worse. And all of this potentially means that the Chinese authorities will have to increase the subsidies that they're providing to these companies to an even higher level. This chart shows the year-on-year movement in food prices, which is a metric that we always like to look at when we're looking at inflation, because the poorest members of society are spending a disproportionately large percentage of their income on food. And what this chart shows is that over the past 12 months, China has experienced deflation in 6 of those months. And the most recent figures for February 25 show that year-on-year food prices are down by 3.3%. And if we expand the scale of this chart, you can see that in February 24, food prices actually fell by 0.9%. So we've got a year-on-year cumulative impact here. Last year prices fell, and this year they've fallen even further. And whilst this represents good news for Chinese consumers because it means that food is cheaper for them to buy, it's seriously bad news for Chinese food businesses. Any company that's producing food in China is seeing a year-on-year fall in terms of the price that it's selling for on the shelves. And that's going to compound the problems that we've just talked about in terms of the factory gate prices falling. And if we specifically look at what's been happening in the last 6 months, you can see that there's a significant downward trend here. And if this trend continues through the rest of 2025, it's going to represent serious problems for Chinese food businesses. So what's the summary and conclusion today? Well, I wanted to post this video because I think what's happening in the Chinese economy right now is really quite worrying in terms of the ability to hit that 5% growth target that it's set for 2025. As we saw from the data earlier, over the last 16 years, we have seen a slowdown in the growth of the Chinese economy as it's got bigger and bigger. However, the Chinese authorities have consistently set aggressive targets in terms of what it's going to achieve in terms of economic growth. And that 5% figure was only just achieved in 2024. There's a question as to whether or not it was achieved, whether or not the figures are 100% reliable. We're still waiting for the final data. But the authorities are indicating that they did get to 5% in 2024. But when you look at what's going on in the world right now and what's happening with Chinese trade, you have to ask the question as to whether or not it's realistic to achieve that same growth target this year, because its biggest single market, the USA, has hit it hard. Donald Trump has applied an additional 20% tariff on all Chinese imports. So that's going to make them more expensive and less attractive to US consumers. So it's very likely that China will see a reduction in its revenue in exports to the USA. And as I've talked about in other videos, it's difficult to find an alternative market to sell those goods into because the USA is so big and the Chinese businesses have got that supply chain all in place. There aren't really many other economies that can take up that slack. But what we've seen in today's video is that the internal demand from China is also proving to be a problem. The contribution from household consumption in China is actually one of the lowest levels in the world, coming in at around 37%. However, the Chinese authorities have been trying to boost the amount of GDP coming from internal demand. They've been providing subsidies to lots of different Chinese businesses to encourage people to go and replace all of their household appliances, to upgrade their washing machine and their tablet and their phone and everything else. So this is one of the ways that China is trying to boost its own GDP. However, it isn't really working. It's struggling. And as we've seen from the inflation data, prices are now falling in China. China has fallen back into deflation. And this is something that it's been struggling with over the past couple of years. And if you follow the channel, you'll know that this was a problem that Japan encountered for a long period of time. And its economy really struggled to grow. And China's trying to avoid the same fate, but it's struggling right now to get out of that cycle. And what we've seen is that producer prices in China have now been falling for 2.5 years. So if you're a company in China, you're selling things today for less than you did 2.5 years ago. And obviously, the costs will have risen for all of those businesses. Raw material prices have gone up, wages have gone up, and all of the other associated costs have risen. So those companies have had to absorb all of those cost increases, and that means that their profitability has fallen, and more than 50% of businesses in China are now estimated to be making losses. And this is obviously seriously bad news for the Chinese economy. And when you look forward for the rest of 2025, the tariffs that Donald Trump has imposed haven't really fed through into the numbers yet. He only added an additional 10% at the beginning of February and another 10% at the beginning of March. And the figures that we've looked at in today's video only go up to the end of February. So it's likely that over the next few months, we will see the impact of those additional tariffs feeding through into the Chinese figures and making things worse. So the overall summary of today's video is that the Chinese economy is currently struggling to achieve its 5% growth target that's been set for 2025. Internal demand is starting to flag. Prices are now falling. Producer prices are down. Food prices are down, and there is a serious question mark over whether or not China will be able to achieve its growth target of 5% for the rest of this year. And if it doesn't, then that will have an impact onto the global economy because China is the second biggest economy in the world. It's buying in lots of raw materials and other things from other economies. So if it slows down, it will buy less of those, and therefore everybody else will see the domino impact. So hopefully you've enjoyed today's video, you found it useful, informative and thought-provoking. Thank you for watching this video all the way through to the end, and thank you so much to everyone that's supporting the channel. If you bought me a YouTube super thanks, thank you for that, really appreciate it. If you bought me a coffee, genuinely appreciate that. And if you've signed up as either a patron or a member, thank you for that long-term support, really does help to keep me going. And here's something to put a smile on everybody's face.